to Mikey's Tasty Treats. So Mikey's already got the sales forecast for the first and second quarters next year. January expects to sell 10,000 batches. These are chocolate chip cookies. 10,000 batches of chocolate chip cookies. 12,000 in February for Valentine's Day. So a little bit peak there. And then in March, 9,000. Nobody really wants them for St. Pat's Day. April, 8,000. May, got Mother's Day, so sales picks up a little bit. June, Father's Day. You don't know what else to get Dad, you get him chocolate chip cookies. So that's how they try to figure out their sales forecast for the first 6 months of next year. The sales budget is simply taking that forecast and multiplying it by what you sell your batches of cookies for. It's really that simple. So if January we forecast 10,000 units and we expect an average selling price of $12 per unit, we're going to have budgeted sales of $120,000. Nothing too hard with that. Instead, the hard part was getting agreement on this. And there may have been some argument about what we're going to sell them for, but usually we have an idea. So February, 12,000 units times $12, $144,000. March, 9,000 times the 12, 108. So our total sales budget for quarter one, $372,000. So sales budget. Everyone agree? Simple enough? Nothing too taxing right after an exam? All right. So that's all there is to the sales budget. Once you get your forecast, multiply it by your selling price, you get your budgeted sales. That's good. That means this would be the amount that would show up on the pro forma quarterly income statement as revenue. 372, because the income statement is cumulative for the quarter. And we know how many units we're forecasting, so we can create a production budget later. Well, yes, financial accounting GAAP is concerned with the revenue number. But if we're going to be a successful business, we also need to figure out then how the cash come in. Because remember, accrual accounting is different than cash accounting. Internally, we've got to be really concerned with both. Because if we don't have the cash to pay our bills, it doesn't matter how much revenue we have. If we don't have cash on hand, how are we going to survive? So, with the sales budget, we come up with a cash receipt budget. So what happens traditionally? Mikey's has 65% of its sales made in cash. Meaning it's either physical cash or it's paid with check. A Visa or MasterCard would even consider cash because Visa and MasterCard pay you immediately. You don't have to carry that as an accounts receivable on your books. You should get those pretty quick. So that's considered cash sales. Now, the other 35% are made on stored credit. I mean, we have either our own credit card, we have it set up on some sort of agreement. Seen these around Christmas that Swiss Colony sells cookies and stuff. They're always offering you their own personal credit option, like 90 days, no payment, whatever. So that would be, a store credit type situation. So of the credit sales, then 10% are collected in the current month. Many people either buy at the beginning of the month and pay before the end of the month, or just they don't like owing anything, so as soon as they can, they pay you. But the other, then 85% are collected in the next month, and typically we're going to have 5% uncollectible. Just allowance for doubtful accounts, that kind of thing. So we're going to create a cash receipt schedule for quarter one. December sales, we need to know its budget is to be $200,000. So what's our cash going to come in as quarter one? All right. So we use our sales forecast to figure that out. call it in the back. There's another sheet of paper. Cash receipts. So that means we're going to look at January, February, and March. So what's the first thing that's easy to figure out? Cash sales. So the cash that we're going to receive in January, we'll start off with that cash immediately we receive. Well, we're told that it's 65% of the sales are made in cash. So if in January our budget sales are 120, or 120,000, and if 65% of the sales are made in cash, 125,000 times 65%. I entered the numbers correctly earlier. Should be 78,000. That's how much cash we're immediately going to get for those sales in January. So that at least makes sense. The cash sale, you get the cash immediately. That's 78,000. Well, we also get in cash from collections. You can label out whatever you want. Cash collections, receivable collected, collections from credit sales. Well, what do we have? What cash are we going to get in hand? Well, we're going to get some from the current month. Of this 120,000, 35% are on store credit then. 65% are in cash, the other 35% are in store credit. So that's 42,000. In January then, we have credit sales of 42,000. So immediately we recognize accounts receivable 42,000 for January. Then what happens? Well, we get some really good customers. Or, they get their bill before the month ends and they pay it immediately. You think about this, you go to the store, you want this iPod. You don't have cash for it right now, but you're going to get paid in a couple of weeks. But you want it now. So what do? You pull out your credit card and you get it now. Now, if you're at the end of the cycle on your credit card, you're going to be getting a bill here in a few days. So even though you bought it at the first of the month, so you bought it on March 1st, if your credit cycle ends on March 3rd, you're probably going to get your bill in the mail by March 7th. So you bought it within March, you got your bill within March, and finally you get paid, let's say on March 14th, so you can pay your bill. And you like to pay all your bills as soon as possible because you don't like to have any debt standing out there. So you pay it. So you bought the iPod, you've had some delay in cash, but then you paid the cash before the month ends. Okay, so that could happen. In that case, it actually happens 10% of the time for our customers. In our general rule then, if someone buys on store credit, 10% of the time they're going to pay that credit, that debt off before the month ends. So if we have 42,000 of credit sales in January, we'll receive in cash $4,200 before the month ends related to those sales. So the complexity starts a little bit here. So 4,200. And then what happens, the majority of our customers, you buy that iPod in March. Typically, your billing cycle isn't going to be immediately following, and typically you're not going to pay that bill as soon as you get it. So what happens? You pay it next month. The physical cash goes out the door next month. And for some of us, it may be 4 or 5 months, but our customers in this case, it's always the next month, or they don't pay at all. So 85% is collected in the next month. Well, we're sitting in January, and we're wanting to know what cash we're going to have in the door in January. That means we're going to be collecting from sales that happened in December. So December sales, where I gave you the budget, $200,000. For $200,000. Again, 35% of those will be on store credit, which will equal $70,000. So in December, Christmas season, $70,000 worth of sales that were made on store credit. What happens? We'll start getting their bills in on January, start paying us. It happens 85% of the time. So our average collection is that the next month 85% will pay. So 70,000 times 85%, 59,500. So cash collections from previous month. And now I often get the question, what about that other 5%? Because we're going to start remembering your other accounting rules. Cash never changes hands. We're dealing with a cash receipt schedule, so we do nothing with that 5% on this schedule. Yes, eventually we'll have to deal with allowance for doubtful accounts and bad debt expense. But those are all non-cash transactions. Yes, we sold some cookies that we're never going to get paid for, so cash never exchanges hands. So there's no cash ever coming in, and there'll be no cash going out related to 5% of those credit sales. Yes, we'll have expenses, but not cash. One of those things that we recognize expense for in accrual accounting, but no cash related. So the cash collections from January. We'll have the cash sales, those sales in January that were made with cash. Collections from January sales that are collected before the month ends. And then those collections from last month, or December, that are getting paid now. Yeah.
The 5% that's unallowable, doesn't that mean that you only collect 80% from December?
Well, I got the 10% plus 85%. So the way I worked it out, of the credit sales, 10% are collected in the current month, 85% are collected next month. That would be 95% plus the 5%. Yeah. So this is all of the percentage of 35 now. So then we add it up. 141. 700. All right. Questions on that? You just have to put yourself in what period am I looking at? And cash receipts, well, you can't collect cash before that month happens, so as far as we're concerned, if we're looking at January, February, March do not exist. So we have to look back to December is what we're collecting from. Can't collect anything from forward. Do the same thing for February. You use the sales budget, $144,000, and we use our percentages. Why don't you try February here real quick?